Wall Street is reopening after the long weekend. The benchmark stock indexes are trading cautiously. Today, investors have to digest the data on the U.S. construction sector, comments from several Fed's policymakers, and the corporate report by FedEx, the final one in the season of quarterly reports. The major stock indexes traded in the New York pre-market on the pessimistic note, but went mixed in the early session. The S&P 500 is expected to trade in the corridor between 4,370 and 4,420 points. The S&P 500 and the Nasdaq notched the highest levels in 14 months on Friday and went down. Today, futures on the stock indexes are consolidating a bit lower. The crucial news today is the decision of the People's Bank of China to cut two key interest rates, including the benchmark for a 1-year and a 5-year loans, by 10 basis points each. This move followed similar decreases of other interest rates last week, but they were less aggressive than expected. On a Monday, Goldman Sachs downgraded its forecast for China's economic growth for this and the next years. So the market is stoking anxiety about the global economic growth. Nowadays, some doubt whether China is ready to announce another stimulus measure to prop up its fragile economic recovery. Still, this dovish rhetoric confronts the ongoing monetary tightening by Western central banks and some improvement between Washington and Beijing. On a Monday, Chinese President Xi Jinping hailed progress in easing bilateral tensions after shaking hands with the U.S. Secretary of State Antony Blinken. At the same time, both sides agreed to stabilize the tense rivalry so that it does not escalate into a conflict. In addition, the UK market was on a roller coaster as the markets increased the bets for the likely peak in the Bank of England interest rates closer to 6% by March next year. While most expect a quarter-point rate hike from the Bank of England this week, 1 in 3 sees a half-point hike to 5%. As for the US stock market, analysts continued to speculate about the bull market over the long weekend. In particular, the Bank of America believes that stocks are climbing the wall of worry, citing bullish market trends that are challenging economic uncertainty and skeptics. In addition, the Bank of America noted that the rally has room for further development. The current rally in stocks looks like 3 similar cases in the past decade, where the market has reached high levels despite tangible risks. The threat of a trade war with China in 2019, Brexit, and the US presidential election in 2016, and the Eurozone debt crisis in 2012. In 2023, the S&P is up 14%, while the tech Nasdaq is up 37%, despite many experts warning of a looming recession. The market rose mainly due to the enthusiasm of investors about the development of artificial intelligence technologies, as well as hopes that the US Federal Reserve is close to ending interest rate hikes. Stocks could benefit from a favorable seasonal trends with a chart pattern signaling further gains. Analysts note that the market is in one of the best seasonal parts of the year, from June to August, when a summer rally usually unfolds. Technical patterns indicate the S&P 500 could rise above 4,500 points this summer, the Bank of America added. Short sellers betting against US equities have already suffered heavy losses this year, thanks to this stunning rally fueled by the hype around artificial intelligence. The sharp rise in stocks during the year saw short sellers suffer losses of about $120 billion, with $72 billion in the first half of June alone, according to the Wall Street Journal. That being said, that bearish sentiment among some investors is fueled by fears that the rally is too narrowly focused on the tech stocks. This year, the S&P 500 has been driven largely by large tech stocks and the fact that some stocks could be overvalued. Meanwhile, rising interest rates over the past year have tightened financial conditions, suggesting the possibility of a recession. While the Federal Reserve is expected to raise rates for the last time next month after last week's skip, markets are skeptical of signs that the Fed could expect 2 more hikes. Fed Chairman Jerome Powell is answering questions in Congress on Wednesday and could provide a little more clarity on a Fed policy. The US data this week comes from the housing sector, where signs of some recovery are raising hopes for a soft landing for the broader economy. On Monday, the housing market sentiment index grew in June to its highest level in almost a year and far exceeded forecasts. U.S. housing construction data for May and building permits released today surprised the market and sowed some gloom in the stock market. Building permits in the United States jumped by 5.2% year-on-year to 1.491 million in May. The increase came after 2 consecutive months of decline and exceeded the market forecast of 1.42 million. The number of permits reached the highest level since October 2022. Although the overall activity in the housing market remained subdued due to the sharp increase in interest rates and stubborn inflation, which reduced demand. The number of housing starts in the United States unexpectedly leaped by 21.7% from the previous months to 1,631,000 in May. This is the largest increase in the number of the new buildings since October 2016. April's figure was revised down to show a 2.9% drop from the originally reported 2.2% gain. In addition to construction data, today on the corporate front, FedEx is releasing the latest quarterly reports, which are an important barometer of both domestic and international logistics and supply chains. Apart from the economic calendar, investors will be alert to speeches by Federal Reserve Vice Chairman for Surveillance Michael Barr, New York Fed President John Williams, and St. Louis Fed President James Bullard. This may put additional pressure on the market optimism. The currency market is still agitated the policy decisions of central banks, and the US dollar index dipped by 0.06% to trade at 102.40. It climbed to 102.60 in the early American session. The instrument is likely to trade in the intraday corridor between 102.20 and 102.80. The yuan and the Australian dollar are under the spotlight today. The yuan slumped to the lowest level in 7 months today after Beijing cut 2 key policy rates. The Aussie dollar plunged by more than 1% against the US dollar after minutes from the Reserve Bank of Australia's latest policy meeting showed that the decision to raise interest rates in June was well balanced. The discussion showed the market that at the next meeting in July, a decision could be made to leave rates unchanged. The euro has been stable with the support from the still tough-minded ECB. The ECB policymakers said on a Monday that the bank could be mistaken on the side of raising rates further, as inflation could be even higher than the ECB expects. At the same time, the dollar index also has a chance of recovery today, and the Fed hawks can give it a helping hand. The day will be full of comments. On Wednesday and Thursday, Fed Chairman Jerome Powell will deliver his congressional testimony. If Fed speakers maintain the hawkish tone despite recent data that points to cooling labor markets and inflationary pressures, the dollar index could recover to at least 103 points. The Canadian dollar weakened despite the soft US dollar. The USD CAD pair climbed by 0.26% intraday to trade at 1.3240, and the currency pair is expected to trade in the intraday corridor between 100.3210 and 13270. After an impressive rally, the loonie began to cool down. It's still not far away from the highest level in 9 months. But optimism about further steps towards increasing the key rate by the Bank of Canada is waning. At the same time, oil prices, which traditionally feed the commodity currency, continue to trade sideways and in search of more obvious signals in terms of supply and demand. Brent crude rose by 0.6% to $76.50 a barrel, while WTI traded 1.3% lower at $70.90 a barrel. The WTI contract did not settle on Monday due to the public holiday in the United States. The expected cut in China's base lending rates was less aggressive than expected, so it did not give a bullish push to the oil markets. The rate cut follows recent economic data that showed that China's retail and manufacturing sectors are struggling to sustain the momentum seen earlier this year. However, China's crude oil demand is expected to increase by 3.5% year-on-year in 2023. A China National Petroleum Corporation division researcher said on Tuesday. Last week, the Chinese government held a meeting discussing measures to spur economic growth. Several major banks cut their forecast for China's economic growth in 2023 amid fears that the country's economic recovery from the crisis is limping. The crypto market is trading with a muted dynamic. The level of a Bitcoin dominance is now more than 50%. The token is extending its rise above $26,500, having rebounded by 0.5%. The crypto is trading at about 26,800, and popular altcoins did not follow Bitcoin, trading mainly in the red. Attention at the opening of the week was riveted to Ether. Ethereum developers have proposed to increase the deposit requirements for validators from 32 to 2,048 tokens, and this proposal means a 6,300% increase aimed to reduce the wait time for validating node setup, which is currently just over 40 days. However, increased requirements could further push the centralization of staking, which could increasingly become the prerogative of larger holders and platforms. In terms of a global centralization, the IMF said on Monday it was working on a platform for central bank digital currencies to enable transactions between countries. The fund wants central banks to agree on a common regulatory framework for digital currencies that will ensure global interoperability. Failure to agree on a common platform will create a vacuum that will likely be filled by cryptocurrencies, and besides, it became known that the long-suffering exchange Binance cancels the registration of its subsidiary in the UK. As for Bitcoin's intraday outlook, the token received a fresh impetus, having gone beyond the upper limit of the range of 26,750. Intraday Bitcoin can test the level of 27,200 and later 27,600. If coin number 1 fails to overcome resistance, then it's likely to slide to 26,200. Follow developments in financial markets on the InstaForex TV channel with us, and subscribe to our channel, and see you online tomorrow.